Good evening, everybody. Our advisor partners, our investor friends, and everybody who's tuned in to another wonderful edition of Edelweiss Connect. The series that digitally kicked off in lockdown continues to grow with all your love and support. I am actually and we are really overwhelmed by the number of sign-ups and registrations and the amount of interest that we got in today's event. We should not be surprised, of course, knowing our speaker. I am actually not going to talk too much, but I do have the honor of introducing Utpal. So I was yesterday telling a colleague of mine in Edelweiss that Utpal is our speaker tomorrow, etc., etc. And the first thing he told me was that Utpal Sheth is a rock star. And I said, yeah, we all know that. We know he's a rock star. He's also, as I've known him, one of the most soft spoken and nicest people I've met. So, in addition to being the rock star that we know him, he's a very, very soft spoken gentleman. He is, no pun intended, a very rare speaker, absolutely no pun intended. And when I asked him to do this session, he says, I speak rarely, but I love to teach. And I said, I think that is very relevant because as an investor and as a human being, I think there's a lot that we can learn from Utpal. He's, of course, very, very successful at what he does. He's a CFA, he's a CA, he's a gold medalist. He started out at Inam and now he is the CEO of Rare Enterprises, which does not need an introduction, a very, very large and successful investing firm. He also, in addition to his equity brilliance, runs and is the founder of Trust Group, one of India's leading fixed income firms. So he spans both sides of the capital market, and I may ask him a question about that later. So with further no delays, thank you so much in introducing Utpal Sheth. I'm delighted to talk to you today, and thank you so much for gracing Connect, Utpal.
Thank you very much, Radhika. That was very kind of you. Just two clarifications. One, trust is run by my wife, Nipa. I'm credited with the mentorship, but nothing, not much more. And secondly, I would also like to clarify that my CFA is the Indian CFA and not the US CFA.
There you go. So Utpal has, and you're perhaps appropriately talking in a mutual fund thing, mutual fund event, Utpal, because you started with disclaimers.
Yes.
And that is very correct for our industry. So I want to kick off this chat with you by asking you, maybe something that we haven't heard too much from you. So I know you started your investing career actually pretty young, after your 12th exam. How did it actually all start, and what kind of motivated you to come into the investing world? And then I have a second question about how you ended up working for Rakesh.
Okay. So, my father used to be the head of research and portfolio management at JM Financial in the late 70s. He was amongst the earliest pioneers of equity research and, a process oriented investment approach that I know of. And then our dinner table conversations were about what was happening in the markets, which companies were doing what. So it was always fascinating. Therefore, the day I finished my 12th grade exams, the next day I joined ASK Financial. And I've been very fortunate to have learned from some of the best in the business, whether at ASK or with my father and at Inam and at Rare, of course.
How did you end up meeting Rakesh and deciding to work with him, Utpal?
So I ended up meeting Rakesh outside ASK's office.
Huh.
And at that time, I used to be consulting with United Breweries and United on shareholder value creation. And I overheard Rakesh talking to someone else while we were all waiting outside. And I didn't know him then. So he was talking to someone Incidentally, that someone was Amit Goela, who's our other partner at Rare Enterprises,
Ah,
about United Spirits and United Breweries. He was telling him that he had just bought a block, and that he would sell if it went up, if it doubled in some time. And I told him, "Excuse me, I am sorry, I overheard what you were saying, but I think this can go 10x." And he looked at me and said, "Why do you think that?" And we got an opportunity to chat for a few minutes. Then he invited me for a drink.
ah,
He was disappointed that I don't drink.
ah.
Nevertheless, he heard me out and he said, "If this does become 10x, then I will send you and your family to Disney World in a Concorde jet." At that time, there used to be Concorde jets.
Oh.
So that is how I met him, and since then it's been a long journey. After that, he used to be our client at my father's broking firm as well,
Ah.
and until and later on, I joined him after Inam.
Interesting. I'm going to ask you about the Concorde jet at some point, but you have seen, I'm sure, many market cycles. You've seen falls, you've seen recoveries, and I don't think any cycle in markets is very similar. But what have been the learnings for you from each of these cycles? I mean, there was the phase of the early 90s, there was the whole dot-com crash, and then there was GFC, and we can talk about 2020 later. But what are your key learnings from the cycles been?
So if you permit me, Radhika, I would beg to differ a little bit. I think every cycle is exactly the same. The causes may be different, the
Hmm.
effects may be different, but the long-term outcomes
Hmm.
of those cycles is similar. So we've done some quite a bit of work on these cycles, and right from the Konrad TF wave, which was a 78-year economic cycle,
Hmm.
all the interim shorter term cycles or relatively shorter term cycles, there are multiple causes. Some can be demand side, some can be supply side, sometimes innovation led, sometimes led by monetary policy, and so on. But the common outcome that happens in every cycle is that the strong become stronger
Hmm.
and some of the weak are eliminated. This
Hmm.
is the classic Schumpeter's creative destruction, right? So that insight that every cycle leads to the same outcome
Hmm.
is what led me to my focus on megatrends and leadership.
Hmm.
And I strongly believe in those two factors. So those megatrends are not disrupted by these cycles. In fact, new megatrends are kicked off by these cycles, and the leaders in each segment keep becoming stronger.
How do you, since, and I was going to come to mega trends, but since you brought it up, I don't want to ask you to, talk about secret sauce, but how do you identify mega trends ahead of the curve? And you don't use the word trends, you use the word mega trends. When do you realize something is a mega trend? And is there art or science in identifying this?
Okay, that's a tough one, and Radhika, there are no secret sources. I think we are in an information surplus age. So it's not the information which is important. It is the synthesis of that information that you make which is important. So we've all learned and we all believe that change is the only constant, right? But change is not the same all the time. While change is a constant, the degree is different, the dimensions are different, the pace is different, the duration of that change is different, right? So there can be a change which is a fad,
Hmm.
which is just a spike, okay? There can be changes which persist for 6 months, 1 year. Those may be seasonal.
Hmm.
There could be changes which persist for even longer, and those could be cyclical. And there are change which persists for a really long time, and the impact of that change is massive in the long run, though it is not easily visible earlier. And those are the big change waves or mega trends, as I call them. And I must say that this is not my terminology. Read about this in a book in the 1980s called Megatrends by John Nesbitt and Patricia Nesbitt. And since then, it stuck in my mind. So I think uh, these changes, these structural changes, which are mega trends, which lasts for more than a decade, and bring about substantial change either on the consumption side or the supply side, or even the distribution side, create a lot of opportunities. And um, this is not enough. It's a necessary condition, but not a sufficient condition for value creation. And we will come to that as to what is the sufficient condition. As regards your point, your question on how do you identify them, it's I would not. It's not neither an art nor a science, but an amalgam of both, and therefore I call it a craft. And that craft essentially is not unique to anyone. I think anyone can get it. It's a question of continuous learning and connecting the dots. And in any case, one need not aspire to get all the mega trends right. You don't have to get all the mega trends right. You can get a few, and that changes your life.
I'm always going to take away this line that somewhere when art and science meet, it is craft. And I might steal that line from you, Utpal. But if I could go to the point you made on value creation, when you look at companies, what are the two, three things that it finally comes down to at the end? And what are those necessary conditions, as you call them, for value creation?
Okay. So megatrends is a necessary condition, but not sufficient condition for value creation. Um, in any megatrend or in any sector, bulk of the value is created by the leaders,
Hmm.
or at least companies which have leadership characteristics. And in some of my past talks and presentations, I've referred to them as the gorillas.
Hmm.
Uh, and I feel that these gorillas take away bulk of the incremental value creation. The trick lies in being able to identify these gorillas. But apart from identifying these gorillas, there are value creation drivers and value destruction drivers. Some gorillas run berserk and end up triggering the value destruction drivers. So it is vital to be able to understand which of these gorillas are not going to go berserk
Hmm.
and will not destroy value. If you've gotten the mega trend right and the leadership characteristics right,
Hmm.
then all you have to do is to prevent the value destruction. The value creation then takes care of itself.
And so it's also as important to realize one, what typically destroys value, Utpal, in your view, in the Indian context? What are the kinds of things that destroy value?
So, the generally well understood value destruction drivers are corporate governance and all of those. I think the less well understood value destruction drivers are capital allocation and capital structure.
Hmm.
I think a lot of value is destroyed by misallocating capital,
Hmm.
by structuring your capital in the wrong way. Right now, these are apart from the usual business drivers that we all talk about. These are apart from the usual management drivers that we all talk about. So, which is why I focus on these subtle value destruction drivers rather than the more tangible value destruction drivers.
The
I,
other, yeah, go ahead. I cut you off. Sorry.
no problem. I also feel that the whole value creation paradigm has moved over the years, right? It has moved from the tangibles to the
Hmm.
intangibles, right? And the sooner the management teams recognize that, they will be able to create even more value. And the adaptable management teams are surely embracing this. And those intangibles are many. I mean, it could be the brand, it could be the business model, it could be some technology change, and so on. So, once you put these few variables together, megatrends, leadership, intangibles,
Hmm.
it gives you a very different framework to look at companies and to look at sectors.
And this, oh, by the way, I just wanted to tell our audience one thing, that as I'm talking to Utpal, I know some of you do have questions. So please post them on the chat window. After my questions are done, and I have a lot of them, we'll make sure to take the audience questions. Just one request, please restrict your questions to not single stock questions. So any question that's not about a single stock would be happy to take. Utpal, one of the things you talk about in terms of your equity philosophy, and this comes back to your point about value, is that you're not just an investor, but you're a partner in a business. And can you talk a little bit about this and how you make it happen?
Okay. So I don't know if we make it happen, but I'll tell you how we try.
Endeavor to make it happen.
Yeah. So I'll tell you how we try to do it. Uh,
Hmm.
I think partnership begins with an attitude and a mindset. It begins with a belief system. Okay. Um, the moment you start thinking about terminal value,
Hmm.
then you start thinking of partnership.
Hmm.
If you are thinking about the next transaction or the next IRR,
Hmm.
then it is not a partnership.
Hmm.
So I feel that is the starting point of that partnership. Also, partnerships, because you are thinking of terminal value, partnerships have to go beyond economic cycles, beyond life cycles, so to say. So therefore, you continue to work alongside the promoters
Hmm.
in different ways. We are not here to teach them how to do their business. They know that better than us.
Hmm.
That is why they are the promoters. Okay. But I think it helps to engage with them, share the value creation drivers and the value destruction drivers, and leave it to their good sense to take from that and do what is best. And I think we've had very good experiences with it, many Indian promoters over the years. We have had our share of lemons, but
Hmm.
that's okay. That is part of the game. And I would never blame any of the managements or promoters um, in any way. I think we are all mature adults. We make mistakes, and there are consequences to those mistakes, and that's it. We move on in life.
Well, when you have, tough times with a promoter, troughs with a company, and of course they're part and parcel of investing, as you said. One of the things that, when we talk to our investor community is, holding power in equity investing is very, very important. And as you said, we live in a news and information driven world. I mean, I keep joking in mutual funds that your NAV may fall once a day, but because of Twitter and WhatsApp, you probably feel it 8 to 9 times a day. How do you find the power to hold on to companies? How do you build that holding power?
Okay. So there is this beautiful book, 100 Baggers by Christopher Mayer. He talks about the vision to see them, the courage to buy them, and then the patience to hold them. Okay. So when I was reading that and I was reflecting on that, I concluded that the vision to see them is the mega trends and the leadership part. However, the story begins there, it does not end there. A lot of people see some of those things, but they don't build up the courage to then buy and then the patience to hold. Also, within the courage to buy, position sizing is a very important factor. People just stop at the point of thinking of buying, but not size it appropriately. They don't calibrate it to their level of conviction. Okay, so the common thread between having the courage to buy and the patience to hold is your conviction. So unless you have that deep conviction, which is not influenced by price volatility, you are not going to even meet the necessary conditions for these multi-baggers. Forget the 100 baggers, let's just talk about multi-baggers. And there I find that you build that conviction only if you have a differentiated insight in the first place. If your insight is exactly the same as others, and it could be the same as others in terms of the factor that is influencing that insight, but it could be different in terms of the impact that that factor has, your perception of the impact that that factor has. So I would strongly say that this differentiated insight, which leads to this conviction, which leads to the courage to buy and size it properly, and then hold it patiently through the cycles, allowing the compounding of that value creation to happen, is very, very vital.
I was actually smiling through this whole thing because I just feel that so much of the media and even the questions that we get in asset management are around stock picks and sector picks, and very little around portfolio management and position sizing, and even in investors' portfolio that plays such a big role, but perhaps it's less glamorous. So it becomes a much smaller part of the conversation. So that's why when you were talking about that, I was smiling completely. I wanted to switch gears to, and I know a lot of people want to hear your view of what has happened in the last 7 months and the world that we're in today. I think one of the things you and I were talking about yesterday when we were speaking was, of course, the obvious question of the confusion people feel because of the dichotomy between markets and what they hear or perceive about the economy, or what is real about the economy. I'm kind of trying to find my words here. So, how do you look at this dichotomy, and do you believe there is one in the first place?
So, let me say that there is an apparent dichotomy, and there are many reasons for that dichotomy. And I could give you economic reasons, I can give you financial reasons, I can give you how the market is focusing on terminal value, I can give you reasons about flows, equity flows, monetary flows. But I think there is one reason which is overriding all of this. And if you permit me, I would like to talk about that one reason here.
Absolutely.
And that reason is what I call as a generational value migration. Okay. Value migration is always happening in financial markets. Okay. But I feel that what we are experiencing right now is a generational value migration. And what do I mean by generational value migration? This is like once in 2-3 decades kind of value migration, where a lot of factors are coming together, where the pace and the direction of value migration, both are unprecedented. And what are these factors which are coming together, or the confluence of factors that is causing this generational value migration? So I will say, first of all, displacement.
Hmm.
Displacement in the sense that I feel we've all talked about the shift from unorganized sector to organized sector. Even within the organized sector, from the weaker players to the stronger players. Now, when we say weak and strong, we think of financially weak and financially sound. But I feel that it is wider than that. Weaker business models to stronger business models. Um, Less competitive to more competitive, and so on. So I feel that there is a displacement going on, and the source of profit or earnings and earnings growth going forward is going to be different from the source of earnings and earnings growth in the past. For example, in the past, inflation, rupee depreciation, crony capitalism, etc., used to be factors contributing to earnings and earnings growth. Given that those easy earnings drivers are no longer present, I feel that we have to recalibrate our thought processes as to what is the change that is taking place. And I think this disruption is reducing competitive intensity, improving terms of trade, enhancing pricing power, and hence adding to the terminal value, if not multiplying to terminal value in the long run. So displacement is one of those drivers. The second factor is what I would say is technology or digitalization. So this is the second D, as I call it. We've seen technology coming up over the years, but I think the pace of adoption of technology and the difference that that technology is making in various businesses and managements is phenomenal. Therefore, those management teams which are embracing this change or which are adapting well will create far greater value. I'm not even talking about the early stage companies which are actually driving this change. I'm just talking of the adapters, because in the public markets, most of the time we are seeing the adapters rather than the drivers of that change. So this is the second variable. The third variable is what I call as disruption. Okay, disruption is not just technological disruption. Here I'm talking about disruption of all other kinds. I think the consumer mindset is changing. The distribution networks are changing. Costs of distribution are changing. The way people are costing their products, manufacturing them, those are changing. So there is so much of disruption going on that value will migrate from those who are not disrupting others, and forget disrupting others, disrupting themselves. Because if you don't disrupt themselves, somebody else will. Like we talk about cannibalization, right? So I would say these three Ds, displacement, digitalization, and disruption, together are bringing about a once in a decade or two value migration. And we are very, very fortunate to be in the midst of that value migration. It is important to recognize that. Here I will quote Rakesh. I've learned so much from him. Um, he says that those who are those who see the change, are prepared for the change, and embrace the change, they win in the long run. So I think we are seeing that in the Indian corporate sector at this point of time. And the terminal value shifts for those companies which are able to do this will be massive. Therefore, it is wrong to think of conventional valuation mechanisms, valuation paradigms, when valuing companies in the midst of this huge value migration. I'm
So
sorry, that was a long winded answer.
no, so it was it started with the dichotomy, which was the D, which it started with, and it ended with three Ds: displacement, digitalization, and disruption. And I think it was a beautifully worded answer. And since you talked about Rakesh ji, I'm sure this is a question that a lot of people have on their mind, is that there has been a lot of negativity around India in the last 7 months, I think from the Achhe phase, and 5 trillion is far away. I think when you listen to Rakesh, there is a lot of optimism about India. I mean, he is called the big bull. What makes you sitting today excited about India for the next decade?
So I would say this generational value migration excites me far more than the macro story,
Hmm.
because I feel that the opportunity for me as an investor is far greater. However, the opportunity for me as an Indian is equally great. Okay,
Hmm.
because I'm not depending or focusing only on the quantum of growth. I feel that the quality of growth is equally important. And I don't want to get into the specifics of $5 trillion or otherwise,
Hmm.
but I can tell you one thing, that whatever growth we are achieving is very, very structural growth, and that growth will yield great results for investors and for the country. Hopefully we will get a very different order of magnitude of scalability.
Hmm.
We will get, hopefully, a very different order of magnitude of competitiveness. I remember a few years ago, maybe 2018, budget, prior to the budget, in the economic survey, there was a phrase that was there, which is talking about the dwarfs in the economy.
Hmm.
And what has happened is that the dwarfs have actually borne the brunt of this transition, right? Right from demonetization,
Yes.
GST,
Yes.
and Corona, and the financial sector tightness and lack of availability of money, and so on. So, the kind of pain that the Indian corporate sector has undergone and the kind of restructuring that it has undergone, I think it changes our paradigm on competitiveness and scalability. And those two factors will drive the India of tomorrow, I feel. It is okay if the growth rate is not as large as it was in the past. I feel that the quality of growth is far better.
Hmm. So you're saying focus not on the headline growth number, which when we are a very growth obsessed country, but focus on the underlying quality of growth. Now, there's, this question had to come up since you talk about mega trends, as you think of India over the next decade, and without being stock specific, what are the few, two, three mega trends that you could talk about that come to your mind, or at least that you're thinking about?
Okay. So I would say, first of all, the megatrend that is top of the mind for me is that we are moving towards a winner takes all or winner takes most kind of paradigm. Okay, and the sooner we recognize that, the better. Which is why the leaders in each business, in each sector, are getting valued disproportionately. The second megatrend that I can think of is, as I said, the shift from tangibles to intangibles. However, these are both very amorphous kind of megatrends. Talking about megatrends that we think of in conventional way, I would say clearly that urbanization, financial deepening, um, explosion of data are megatrends that are apparent now. Maybe some of the mega trends which are not yet very apparent
Hmm.
um, to me are health um, in all its dimensions, and skills in all its dimensions. And I think there could be phenomenal opportunities in those areas. Um, so let me share one name with you. And given that it is an unlisted company, I can talk about it. We One of our investments in recent times has been a company called Star Health Insurance, and that investment that we made was out of a deep conviction in this mega trend. And at that time, we were not sure of how quickly this mega trend would play out. But COVID has been a catalyst in that, and which is what I was telling you, that we are living in a generational value migration, and therefore the adoption of that mega trend and the acceleration of that mega trend has been massive.
Hmm. In fact, Rakesh, I think, had just done a beautiful interview where he talked about the healthcare opportunity. And I think skills is one that hasn't been talked about. I wanted to ask you, Utpal, two questions from a conventional investor perspective who are listening in. So, one of the trends that we have seen in the asset management business is that many Indian investors are now looking to invest outside of India. It's partly some successful companies in tech outside of India, partly diversification, partly some of the healthcare companies outside of India. What is your take on the Indian investor investing abroad and the US opportunity versus the India opportunity?
Okay, so I think there are opportunities all over the world, and many different opportunities in different geographies, in different phases of their life cycle. As an investor, I don't think it is wrong to think about investing opportunities outside of India. Um, in many ways, I feel that you have to invest out of your conviction, and therefore, if you have that conviction that there are these kind of opportunities outside of India, then you must make them a part of your portfolio. But I can tell you that there is no dearth of investment opportunity in India. It may not be the same, those opportunities may not be the same as one has in the US. We don't have the Amazons and the Microsofts of the world, but we have our own different companies which are riding those mega trends, which have demonstrated their leadership characteristics, which are the gorillas of that jungle, and which are not going berserk. Therefore, one has to choose which opportunities one pursues. One need not pursue all opportunities. And just saying that I also have something, I mean, I have a healthcare stock and I have, let's say, a US option and all, is all nice. What is really important is, are you backing your conviction? How are you sizing that conviction in your portfolio? And Michael Mauboussin used to talk about how you size it based on your perception of probability,
Hmm.
right? So I feel that wherever you feel you have the deepest conviction and the highest probability, you should go with that, keeping in mind, of course, risk management principles. And I would not rule out investing outside of India as well.
So I will thank you for those lovely answers. And I know there are tons of questions, Utpal, waiting for you, and I encourage others to post them. Till those questions also come in, since it's Friday evening and people don't get upset at me for doing this. And I know you don't drink. So I usually host this rapid fire section called Rum with Radhika. So I will try and ask you not too many controversial questions, but some fun one-line answers. Some are my questions, by the way. Some came from the audience. So here goes. If you could tell me the biggest thing that markets have taught you over decades of experience.
Humility.
Humility. Oh, that's evident in you through and through. Now, as someone who's gone through so many years and decades of markets, for the new investors coming into equities, either directly or via mutual funds, what's the one piece of advice you would have for them?
See, equities is a very serious long-term um, journey, and along the way, you will have temptations and distractions. I would say avoiding those temptations and distractions is half the battle won. Um, that would be that would be what I would say.
So, the one thing that you really admire about Rakesh as an investor, and I'm sure there are many, but the one thing that you really have taken away from him?
I think backing your conviction and
Back,
believing in people.
believing in people and backing your conviction. If I had to give you, and it's a very small amount, if I had to give you 1 crore today to make fresh investments without naming stocks, where would you make those investments today? And they don't have to be equity, by the way.
I would invest it in India. I feel there are tons of opportunities in India. And within India, of course, there are many opportunities. Let's not get into which asset class and so on. But I think India provides phenomenal opportunity.
Another slightly tricky question, but if I had to ask you to run the finance ministry for a day, what is one change you would make?
It is way too above my pay grade. I'm not qualified.
Okay. And the last question, because you alluded to NIPA, you have been an equity czar for all these years. NIPA, of course, is a fixed income queen. Both equity and fixed income are important parts of the portfolio. But at home or in life, equity or fixed income, which one? Or husband or wife?
I would say, we used to think that we are well hedged
Hmm.
always, until we realized that in specific times of financial crisis in the economy or in the financial markets, both of them move in the same direction. So I would not say one above the other. I strongly believe that both equities and fixed income have their own vital roles in everybody's portfolios and asset allocation. I can tell you that I have both in my personal asset allocation.
There you go. My favorite asset management product is a BAF, which has a mix of both. So this is a proof of that. So thank you so much, Utpal, for bearing with all my questions. I'm now going to take a couple of audience questions. I do realize that there are about 50 of them already, but I'll try and take some of the interesting ones. So the first one, which I'm very curious about is, there are a couple of questions on financialization being the big word, and what's your opinion on the sector, asset management and insurance? So your opinion on the AMC and insurance industry, and this I have to listen to.
You are actually participating in it actively, so you are at the forefront. Anyway, I believe that there is tremendous potential in both these sectors. uh, the structural business characteristics of both these sectors are very, very impressive. Um, one should find the right players in these sectors and back them to the hilt.
There's a question that you had, and I think someone has seen one of your earlier talks on how technology was a mega trend. The question is there a sign of a consumption mega trend starting, especially post COVID? And you already talked about this, where consumption patterns and habits are changing.
Yes, I think consumption has been a mega trend and will continue to be a mega trend for many, many years to come. Okay. However, within this large mega trend, there are undercurrents which one must appreciate. And historically, the role of brands, the role of distribution,
Hmm.
the role of affordability um, was different, and a lot of those variables continue to play an important role. But I can see that there is change at the margin, and that change at the margin will become larger tomorrow and will impact value tomorrow. So I would agree that consumption is a mega trend which has been there and which will continue to be there.
There's a question, an individual writes that I want to ask you about the leadership qualities of the company. What are the leadership qualities that tell you that a company could do well, benefit from a mega trend? And how do you identify them in small companies where, the leaders are less popular and established? A very interesting question, actually.
Right. So there are multiple dimensions to leadership. Sometimes you see leadership teams which are battle tested, right? So the more larger ones, the more well-known ones, they are battle tested. They have the systems and the institutionalization
Mm,
to actually go through those waves. And he's right that in the relatively mid cap and smaller cap companies, we don't have that. Okay. But um, there are certain attributes to value creating management teams that are consistent. One of them is adaptability, which I talked of earlier.
mm,
If a management team is not adaptable, they will only create finite value. The second thing is the willingness to share. So there are management teams which are not willing to share with the minority shareholders, and I mean they have their own reasons for it, and I'm not judging anybody here,
mm,
but I feel that the willingness to share is the way of creating value tomorrow, or rather going forward. A third thing has been integrity. A management team can make mistakes, and that is fine. We as investors live through those mistakes. And while they are painful for the investors, they are more painful for the management teams. But what we cannot live with is malafide. We cannot live with a question mark on intent. And time and again, that has been proven. So the question is, how do you judge intent?
mm.
Right? Um, it is something which is visible over a period of time and not overnight. Uh, in the digital era, now that you have time-stamped results, time-stamped statements, you have access to so much of information. You are able to put together whether the management team has been consistent or not.
Hmm.
Have they been prudent or not? Have they made capital allocation mistakes in the past? Have they made capital structure mistakes in the past? Have they learned from their mistakes? And so on. Those are the intangibles that one has to keep thinking. And these are very soft aspects. So I'm not sure if I have the right checklist here.
And I think one of the learnings from you is that it's not about the hard corporate governance and promoter pledging and the basic criteria. I mean, things like learning from mistakes, ability to adapt, consistency. I think these are very, very soft things. There was a question that came to my mind, and also someone asked it. In our industry, Uppal, there is a lot of obsession about this large versus mid versus small cap. And is there a difference in the way you evaluate what is quote unquote a small cap or the way you evaluate what is an opportunity in a large cap or mega cap, or are these just industry classifications?
So, see, I think the kind of responsibilities that a third party fund manager has are very different, and therefore I should not comment on that. The way we think about it is we are size agnostic. For
Hmm.
us, it is not large cap, mid cap, small cap alone. It should be meaningful for us in our portfolio, and whatever we are anticipating or which we think will unfold in the future should make a meaningful difference to our portfolio in the future. That is how we are thinking about it. And what happens is you think in this way when you're evaluating each individual opportunity. But over a period of time, the gorillas in your portfolio,
Hmm.
keep becoming larger, and that gives you the ballast to actually look at opportunities on the fringe as well,
Hmm.
right? So there is a balance of that ballast in your portfolio that you must keep, and therefore I don't think there is any one answer of large cap or mid cap or small cap. And especially at Rare, we are investing both in public markets and in private markets. So we are seeing opportunities, and we are agnostic to opportunities. I think every opportunity has to fight on merits, and that's it.
And the question I had is that as a minority shareholder, and again, this question came from an investor, do you feel that, and maybe you can answer this for both public and private markets? Well, how do you deal with the lack of information in private markets? And do you believe minority shareholders get today enough access in the public markets?
Okay, that's an interesting question. First, let me talk about the private markets. We've consistently found that companies which have good information systems
Hmm.
than the ones which don't have good information systems. So I feel that lack of information is not necessarily a problem. Helping them frame the information that they have and put it in the right context is very important. We are able to see companies changing their decision making frameworks once their information frameworks change. Um, in this era of information overload, I
Hmm.
feel that management teams have information. It's a different question whether they are willing to share it or not.
Hmm.
But we are in the business of connecting the dots. So, whatever information they share, it is up to us to read between the lines. Coming to the other part of your question, whether minority shareholders in public markets are getting enough information, I think by and large, we are getting far more information than I have seen in my career in the past. And there is no end to information. So always people will keep asking for more and more. I think people have to really focus on what is what are the key variables and only focus on that rather than too much of information. Rakeshji again, quoting Rakeshji again, he says analysis paralysis. So we should not have analysis paralysis.
So there's a very interesting question, and it is okay if you don't answer it. I keep getting asked my views on this asset class, but if you have a view, how do you see the whole Bitcoin and cryptocurrency space coming up? And again, if you don't want to answer it, please feel free to skip it, but it's a question that comes up a lot.
So I don't have enough understanding of that. Whatever little understanding I have from a distance, I see that digital currencies is a future. But whether it will be these digital currencies on the fringe or it will be a mainstream digital currency that will make it is, I think, up in the air.
There's another interesting question, and I think it's in the context of the US elections. But how have you seen the impact of elections on global markets and on companies in the medium term? Is it a lot of media, or is there a material impact? And is it different from India and the US? And I think this is coming up because of so much noise around the US election.
Right. So I think elections have an impact and have a long term impact on various policies. But I see that policies around the world are far more aligned than in the past.
Hmm.
Okay, everybody is learning from one another. The It's not that no mistakes are being made, no policy making mistakes are being made anywhere in the world,
Hmm.
but I think people are continuously learning from those, And therefore, I think elections are becoming less and less important in that context, unless they are changing any of the fundamental foundations of that country.
So there are two last questions I'm going to ask you. One is a question specific to Rare, that in this world of Indian startups doing so well, is an enterprise like Rare ever open to investing in startups? Will that be something that happens?
See, I feel we do not have the competence to um, do startup investing. We don't have the stomach to see the mortality rate and the cash burn models. And therefore, I feel we are not well equipped to be startup investors. But that does not mean that there is no opportunity in that space. I am sure there is opportunity, but we are happy not pursuing all the opportunities.
And I think that's one thing that came through in all the interviews, and something we tell investors also, that you don't have to pursue everything that is out there to be a good investor. I would like to thank the overwhelming number of people who came in and logged into this event. This was one of the largest Connect events that we've hosted. There's an absolutely vast number of questions. So really, on behalf of the entire Edelweiss mutual fund team, thank you so much for your tremendous participation and event attendance here. And please do give us your feedback on what we can do in terms of events and how we can make this platform more interesting. I think we've had a range of speakers all the way from Monish Babrai. I think we had Gaur Gopal Das, Vishwanathan Anand. We spoke on real estate. We've got Utpal today. So please give us your feedback. Thank all of you for your tremendous participation. It was a great event, and I wish you all a safe and very happy weekend. And again, thank you on behalf of Edelweiss and Edelweiss AMC.